Mindset Reset, Free Cash Tuesday. What a day for FAFOZilla. So we're going to talk about a few things, some excellent questions. Today was almost a textbook perfect opportunity for traders that were prepared and recognized the opportunity on gold. Now, just to reinforce the simple understanding that learn from gold. If you're not experienced, you shouldn't, number one, you shouldn't be trading the news, okay? We'll talk about the news candle, the 4 types of news opportunities and situations that I look for on gold, and typically gold on news because it rinses and repeats, does the same things over and over again. These are setups, but you shouldn't trade gold if you don't have experience. You should be studying gold because as we see today, now I'm going to talk about gold specifically, because I consider myself an expert on gold because I cut my teeth on gold. And what I mean by that is that when I break things down like this, that's from a lot of painful learning, a lot of painful mistakes, a lot of impulsive or irrational, as I said yesterday in my video, if you don't learn from your mistakes, or if you don't learn from losing situations, impulsive, irrational, emotional behavior, erratic trading, 50-50 trading. If you don't learn from any of that, those are mistakes. And if you keep doing the same things over and over again, that is the definition of insanity. If you can learn from those losing situations, you can earn from them. And then it's no longer a mistake. It's a learning experience that you can transform into a rinse and repeat cash machine, an ATM. So number one, gold. So I'm going to talk about the 4 types of news releases. And remember, these are setups. So it's not about just the first minute. You need to understand what the setup is. So if you don't, so traders asking me, can you go over that again? Because they want to trade the news. But I'm going to reinforce this to you. Do not trade gold and don't trade the news unless you have experience and you've built that up, that confidence up through accomplishment, through repetitious learning, through putting runs on the board in your demo account or whatever else. Otherwise, don't trade it because you'll end up, engaging in behavior that might end up doing destructive damage to not only your psychological capital, but your financial capital. So number one, first bounce is part of a larger template. So first bounce will always be coinciding with a larger time frame setup. Every single entry opportunity that I look for on a major red news release, and there are different varying explosive types of move, PPI, CPI, non-farm ADP, non-farm payrolls, they're all major movers. FOMC, I don't trade that typically because I just don't come back to the screen. There are opportunities there that still relate to this, but they are all part of larger time frame template setups. What that means is that other time frame traders will be driving those moves. So first bounce typically will coincide with will be an explosive breakout that comes back and coils for the continuation on a first bounce, re-entry into the explosive move. Okay, first bar, we will get 3 levels of rise or 3 levels of drop. Now, I talked about when a market opens up out of balance. I want you to go back and look at the gold chart today. We broke out of the previous, of Monday's high, the opening range high. We are out of balance when the news opens. Up high, 3 levels of rise. We've broken out of yesterday's high. They've pumped it up. No other news catalyst prior to making that market pump up. Why did it reverse and pump up and take out Monday's high of day? So you have to ask yourself that question. But you also want to look at the type of template on the day. We have volume up high. We had a rectangle of volume on top of the previous day's high. First minute acts as an open. So gold opens at 8:20. Go back and look at the timing chart that I put up. I'll put it up again today. 8:20 a.m. gold starts to trade, but we have major red news at 8:30. So what that means is that the market opens at 8:30 for me on gold, right? So that can act as a news momentum catalyst opportunity. We're up high. We're in a broken down market that's made lower lows. So we took out the previous day's high. I said that yesterday. A market can break down, take out the previous day's low. We have lower lows on the inside. It can pump up and trigger the high of the day, break down, and continue for a range expansion on the downside. So first bar explodes. Now, I'm not going to go into the first 30 seconds or anything like that, but the first minute, somebody asked me, how did you get in underneath of that level before the minute close? Because I'll get in before the close of the minute. I will. But I wait 30 seconds, and towards the close of the minute, when the level is trapped, I will go there and get into the market with an initial starter position. Another excellent question is, where do you put your stop? And I've talked about this before. A max stop on any trade that I will take is 25 pips. What that means is this. So typically, I'll try to keep it to 15 to 20 max. Oil, gold, indexes, 25 on a news momentum catalyst. A news momentum catalyst. The thesis is we have the whole upper level trapped. Do you understand what that means? It's a news momentum catalyst. What that means is this. If they go back, they allow traders that are long in the market to get out of a losing trade. It's a news momentum catalyst. News momentum, and I said this yesterday, on a news momentum catalyst breakout, do not counter trend that move, because they may not be coming back for that specific reason. We're now going on a range expansion. Another excellent question. How do you define your range expansions? I talked about that yesterday. Where is your consolidation? High and low of the day. We had a very well-defined box. We triggered other time frame traders into the markets in the long direction. We've allowed other time frame traders that have been driving this market down to now come in on the news heavy and position ourselves in with a starter with a news momentum catalyst. And I said I can add up into the 5-minute mark, because the 5-minute close is outside of the range, and now traders look at that and they go, well, it's too big, where do I get in? The same thesis applies. It's a news momentum catalyst. If they go back up, they allow losing traders to get out of the trade without either a loss, with a smaller loss, or even break even. So understand the thesis driving that after a major red news release that has high impact, such as CPI. So if you're not in that trade, the next most important time is the new hour or the New York equity market open. So train yourself to not chase movement. Train yourself to learn to tell time and pay attention to the clock. I'm not joking when I say count to 3 and learn to tell time. People get offended by that, but it's the truth. So 9:30 New York equity market opens. We have a consolidation on the 5-minute chart. 9:30 opens with a little pin high for a re-entry in an existing range expansion trade opportunity. A 1-bar stop. We're above the low of the day, targeting a range expansion of that consolidation at a minimum. So a re-entry opportunity at 9:30 equity markets open. Now, this is separate from the indexes, but the indexes offered a similar opportunity, trapping people, bottom feeding after a news momentum catalyst, which may come back later. It may come back later. But trying to bottom feed or pick tops or pick bottoms is not a trading setup, which we will talk about in one moment here. So important to understand that. Just trying to scalp bottoms or pick tops and catch a move is not identifying a parabolic trade setup opportunity, either targeting a range expansion or a high, low, low, high trade opportunity situation. So, okay, so first bar, we talked about first bounce, larger time frame thesis, breakout, repositioning ourselves into that 1-minute coil on the first bounce. First bar, traps volume either up high or down low, and it will not come back until it reaches the other side. Sometimes it may just be till the low of the day. We were in a large move. We had breakout traders. We had levels to the left of us. That market was not coming back. We could go 1 hour, 2 hour, 3 hours. So, number 3, wicks on both sides. You've heard me say this before. I avoid that, and I will look at the new hour or the following hour after that. Equity market opens. What that is typically volume in a range. They wick both sides. They go into consolidation, and they'll either work up to a high or to a low for a move back to the other side. And again, you want to understand what is your risk reward opportunity on that instrument that you're looking at. What is the high low of the range? Is there a larger time frame setup there, or is it a garbage chart and you're just trying to get in somewhere and catch a move? So always trying to identify a parabolic trade setup. And number 4, nothing happens. There's no explosive wicks. It could be a non-US dollar cross pair, and it may just go back to the original thesis. Maybe 9:30, an equity market opens, a second hour trade opportunity. If it's oil, it may not respond to certain major red news. But then the thesis is we just go back to the original plan. If there's a sell high or a buy low or a parabolic trend trade opportunity, and there's no wicks, there's no first bounce, there's no first bar, explosive type movement, then we go back to the original thesis and just trade as per usual, executing based on universal entry criteria for either again, a trend trade or a reversal trade opportunity. So if you are not in that market, that's where self-management of yourself comes into play. You're seeing all this movement, you want to get in, and they'll entice you into trying to sell it down low or pick a bottom or pick a top. And you need to understand and be able to manage yourself and recognize that, yes, the market's moving. There's movement there. But is there an actual trade setup? Is there an actual trade setup? Is it 90-10 or is it 50-50 where you're trying to trade movement versus I actually have a trade setup here that I can execute for a range expansion, whether it's a reversal now or a continuation trade in the existing momentum trade that's already in play. So out of balance, that gold trade was textbook perfect. It opened out of balance. It opened outside of the previous day's range with a textbook well-engineered 3 levels of rise template. First minute, then up to 5 minutes for a continuation and a range expansion on the downside. Huge day. Congratulations to traders that hit that trade. And again, if you are not experienced, learn from it. Don't trade it. Learn from it. Study those 4 types of opportunities. They existed on the other instruments, but gold obviously will have a lot more movement. So British pound, the euro, other major pairs offered those. They just won't move the same distance. Obviously, less risk, less reward. So now talking about the spreadsheet that I posted last night, building yourself to a 7-figure trading account starting from $1. Now I got all kinds of wood ducks coming out of the woodwork on that one saying, you know, that's impossible to double your account every single day and you're risking 100% on every trade. And nowhere in there does it say you're going to risk 100% of your account and be doubling your account every day. But what it does say is if you target 90-10 parabolic trade setups, you can grow that account, whether it's day 1, day 2, day 3, whether it's week 1, week 2, week 3. It never said about doubling it every single day. That gives you a reference point for where you're at on that spreadsheet. If you go to $2, then that level you've accomplished. How long does it take you to take $2 to $4? Okay, so now you're at that level. But nowhere in there does it say you're risking 100%. Understand 90-10. 90-10 means that you're targeting setups where it's easy to make money on, where you almost have a 0 chance of losing. So the wood duck mentality is I'm going to the market every day and I trade the market. Yes, you at some point will blow your account up risking 100% on a trade because you're trading movement, whereas the professional is targeting 90-10 trade setups and they will grow their account up. And there's a distinct difference in the mindset of that type of approach to the markets where I execute a very specific type of trade setup opportunity, like first bar. Whether it's a 3-session setup. Isn't it interesting? We're at the US Open. a major red news. We're out of balance at the high of the day, 3 levels of rise on day 2. Day 1, day 2, opening range, initial balance. I mean, it's a trade setup that shows up again and again and again on gold. That's a different type of setup than a first bounce. That's a different type of setup that wicks both sides. That's a different type of setup on a market that just doesn't have a big response, or it's coiled inside and moves to the high or moves to the low. Those are not the same. Selling a high, buying a low. That's trading movement. But if you have a well-engineered chart and a 3-session template for a parabolic opportunity at 9:30, at 8:30 a.m., if it's a currency or if it's gold, there's no major red news on the schedule, you may have a very specific setup that you're trading. So please explain. I get this all the time. Go back to the playlist. I go over this repeatedly in almost every video, the different types of situations, but we're not trading movement. We're trading setups. And there's a big difference with that. FOFOzilla has a name. And as I said, FOFO is not a good long-term trading strategy. Focus on setups. Focus on setups. Focus on the timings. Protect yourself at all times. If you're focused on setups, your trading is stress-free. It's rinse and repeat. And don't ever feel that you have to be trading every day. So if you missed the news, another trader mentioned they missed the news today. They got home a little bit later. You haven't missed anything. You haven't missed anything. Because why? Because the same opportunities are going to be there tomorrow, the day after, next week, next month. Rinse and repeat. Scale it up in size. There is nothing new under the sun. Free Cash Tuesday, traders. Keep getting better. 1% better every single day. There is not a day that goes by that I do not learn something from the market. Have a great day, and may the markets go with you.